Hi, happy Monday. This is Dawn Connors at Mortgage One, and we are talking about how do student loans affect your mortgage approval. So let's get started. Before I do though, please like, share, and subscribe to this video. I do videos every Monday and every Wednesday on mortgage topics, and that's what my YouTube channel is all about. So I definitely appreciate the support. So, student loans. They can be pretty complicated for sure. And the thing is, it's really dependent on the loan type, really, is where it matters. The difference between an FHA loan, a VA loan, a rural development loan, and a conventional loan. And even in the way of conventional financing, there's variations within Fannie Mae and Freddie Mac, which are the two main lending sources. So let's kind of unpack it a little bit and see if we can provide a little bit of guidance on student loans and how it will impact your ability to buy a house. So, conventional, let's start there. Conventional has two different trains that you can get approved on. You can either get approved with Fannie Mae or you can get approved with Freddie Mac. And Fannie Mae usually requires that we use 1% of your loan balance as your payment. So if you have a $100,000 loan balance, then $1,000 will be your payment. On average, usually, Freddie Mac has a calculation of 0.5%. So that same $100,000 has a payment of $500. That's half the payment counted against you in your debt to income ratio, which then qualifies you for how much house you can buy. So as a lender, knowing the rules and understanding them is super huge. But then there's other things to think about. Are you in forbearance? Do you have an income-based repayment plan? Do any payments at all show up on your credit? Are you in deferment? Are you in repayment? So these are issues and questions that we have to answer that will affect, can we use something different than that 0.5% or that 1% with conventional financing. And so, for example, if you're in an IBR payment plan, and let's say your payment for $50,000 is $20 a month. If that $20 a month is going to continue for greater than 12 months, with conventional financing, we most likely can use that payment. However, with FHA financing says, nope, it's a government, we're doing a government loan and we really care about that student loan being repaid back, so we're going to make sure that you have to use 1% as your loan balance as your payment. So that $100,000 balance that you have is going to have a payment of $1,000, no ifs, ands, or buts. And then there's VA loans, veteran loans, that say something different altogether. It's usually 5% of your loan balance divided by 12, and that equals your payment. However, if your deferral is for long enough period into the future, then that payment may not have to be counted against you at all. Or if you have an income-based repayment plan and you're making payments on the payment plan, then perhaps that can be used. I would say the key is right now being in forbearance or deferment and having zero payments, then typically we have to use what's called a worst case scenario. So it's wise for you to get with your lender, figure out what you need to qualify, what you need to do with those student loans in order to qualify, and then go to work to get that accomplished. Maybe it's kicking those loans out of forbearance and starting to make payments on them. Maybe it's your IBR payment plan is coming to an end in 3 months and is creating a new income-based repayment plan and requalifying. Maybe it's starting to make payments on student loans that are currently deferred that will start to kick in 3, 4, 5, 6 months. The important thing is to get with your lender and to have a clear picture and understanding of the roadmap that you need to take with student loans. Because student loans, even though they say zero on your credit report, we cannot use zero, because on a mortgage that's 30 years old, that's going to last for 30 years, eventually those roaring payments come due at some point in some way. And so we have to look at what does the payments look like in the 12-month period, in the 3-year period, and what's it look like at the fully amortized payment. Maybe you have a payment of $256 a month and it's for the life of the loan. Well, then that's a fully amortized payment, and we should be able to use that payment across the board. You see what I'm saying? So there's definitely some good stuff with having a great lender that can help you navigate those waters. And I would not recommend that you Google search student loan repayments, because there's over 20 variations of repayment plans and structures depending on the loan program, depending on whether the payment is in forbearance, in deferment, fully amortized payments. Are you in repayment? Are you paying? Is it showing up on your credit report or not? You see what I mean? So Googling is not the best idea in this scenario. It's getting with a trusted loan officer such as myself that can help you navigate through those waters. This is Dawn Connors at Mortgage One. Thank you so much for watching this video today. I'm really grateful. And please remember to share this video out to someone that would benefit, and subscribe to my YouTube channel. Thanks for watching.